There is great news about COVID-19 vaccines, but the virus is spreading fast. These uncertain times create a volatile stock market. What you should do to protect your investments. I'm Erik Brenner. We'll have some answers right now on Your Wealth Health, plus an offer that could help you with those tough investment decisions. Hello and welcome to Your Wealth Health. I'm Erik Brenner, owner of Hilltop Wealth Solutions. Thanks for joining us this morning. If you're watching us on Facebook, please share us with someone who could use this information. And thanks to those of you watching us on yourwealthhealth.com. Joining me today is Bill Davis, a private wealth advisor for Hilltop Wealth Solutions. He's in the studio with me, but we're continuing to practice social distancing. And from his home office in Valparaiso, Matt Aurenz, our Director of Wealth Management. And today we're going to talk about investment strategies. Today, during a volatile time in the stock market, we have positive news about COVID-19 vaccinations, but at the same time, the virus is spreading fast across the country. There is hope, but then there is concern. And there are other factors impacting our economic reality. We have a graphic that shows the current underlying issues that impact the markets. And so, Bill, we want to kind of take a look at those as it relates to what we think are some of the highlights. So if we take a look at this graphic, the first one is economic recovery. Are we underway with an economic recovery?
Yeah, we are slowly coming out of the pandemic recession, and more and more industries are opening up, and we're seeing a much broader stock rally because of it. So, early on in the pandemic, we were having very thin number of companies that were participating in the rally, and now we're actually starting to see that broaden across more and more stocks. And the pandemic control, I think, is what we're most concerned about now, with the spread that's continuing, and that could get many areas of the economy starting to shut down again.
Yeah, and so there's also a lot of this political uncertainty, Matt, that is going on right now with it appears to have obviously a new president and Biden taken over, and so there's some undecided factors there.
Yeah, significant undecided factors, the potential for the contested election, not having a smooth transition at this point, and still uncertain with what's going to happen in the potential Senate runoff in Georgia, and will that end up being Republican or Democrat, and will the Senate majority still stay with the Republican Party, keeping kind of a balanced mix when it looks to the presidential Congress and Senate. So still a lot of uncertainty out there, which the market is obviously responding to on a daily basis.
Bill, and they've called it now Vaccine Release Monday. So it seems like about every week over the last several weeks, we've gotten really positive news about vaccines that have high efficiency numbers. And it appears that, within just a few weeks can kind of start getting distributed and, getting implemented into our system.
Yeah, I think with, Pfizer getting emergency use authorization, filing for that this week, could be receiving in the next couple of weeks, that they're saying, they could have shots in the arm by the end of December. AstraZeneca, at the time of this filming, just got approved with pretty high efficacy rate. And so, although positive, what we know is it's going to take a long time for the broad population to get vaccinated. So it's this time period between now and maybe the next 6 months that, as we were thinking about this show, that people might want to reconsider looking at some of the risk factors in their portfolio, because we would expect, as we start to learn more and more about who will get the vaccines first and second and third, that the markets will respond and have responded pretty volatilely even over the last couple of months.
Yeah, so I think one of the things that we wanted to convey to the viewers today was that the stock market seems to be pricing in the destination. Right, the destination's positive. But Matt, that journey along the way, we think could have some ups and downs and some volatility to it.
Right. I think the journey is going to be significantly volatile. There's going to be a lot of moving components with much of what we've already talked about. Governance, taxes, is the economy staying open, potential shutdowns here and there. Also earnings season. going into the fourth quarter, what that looks like. So I think there's a lot of moving components, but we are saying if you position your portfolio for the long term and know what that destination looks like, you're gonna ride the wave a little bit on the journey. But as long as you're comfortable with the risk in your account, you'll be able to sleep at night.
Yeah. And Bill, what about another stimulus bill? It's been talked about, and how do we think about that? Is it needed? Let's frame that up for folks.
Yeah, it really concerns me that that we just don't have the political willpower during this interim time period between the election and the next president. So I'm really concerned that, yes, I believe we need it, but I don't believe that there's going to be that political willpower to push something through probably prior to the new president. And that's disconcerting to me, because I think this is a time period right now where pandemic uninsurance employment's going to come out, going to stop at the end of December. And, we've never had more people out of work, more people that, are having a difficult time making their mortgage payments. And so there's some action that needs to be done. There's a lot of people that are hurting.
There's been some talk of maybe a smaller stimulus package, something, but not something of size that we really think will help kind of give another boost to what we need going into 2021.
Right. I think we definitely need one, and it should be probably pretty significant in size.
Yeah. Well, one of the things on our graphic there, Matt, was taxes, and so we're getting a lot of questions around, are taxes going to go up? And concerns about that. So how do we think about that?
I think realistically, we're saying we're in the lowest tax bracket, personal tax rate and some corporate tax rate that we've seen in a long time, or maybe ever for most people. And I think, to Bill's point, stimulus packages coming out, they have to get funded somehow. They can't just continue to print money. They have to pay that off at some point, and tax revenue is one of the ways to do that, especially if, other types of stimulus that Biden's campaign is talking about, with erasing of some of the student loan debt that's out there as well. So taxes, I think we're believing, are going to go up. And I believe if you ask most people would agree that taxes will go up, even if it's just a repeal of the Trump laws or just the expiration of the Trump's tax cuts in the mid 2020s here. So if taxes do go up, what that means is people are going to have to figure out a way to survive on less income, less net income coming out of their paycheck. They're also going to have to look at different opportunities on how they save, where they save, tax vehicles for retirement, those types of things. So it's really just a good time to begin to plan for. We know what the tax code is today. We're not sure what it's going to be next year, the following year, and begin to start positioning assets accordingly to take advantage of those laws.
Great. Yep. Thanks, Matt. This is certainly, we think, is going to be a volatile time. And, if you have questions about your investment portfolio, we want to help. We're offering a complimentary investment analysis. It's a value of about $800 to $1,500, but we will underwrite those costs. And to take advantage of this offer, call the number on your screen. That number is 574-633-1476. Again, that's 574-633-1476. We have people standing by right now to take your call. But you can also sign up for this offer on our website at hilltopwealthsolutions.com. We'll have that number again later in the show. Still to come on Your Wealth Health, some specific strategies for dealing with this volatile times and making the most of your investments. But first, here is that phone number once again for our offer as an investment analysis without any charge. Stay with us.
At River Valley Construction Group, we pride ourselves on being one of the top deck builders in all of Michiana. If you want to have a beautiful deck, whether it be wood or composite, contact River Valley Construction Group today. River Valley Construction Group, where we're building your dream deck in 2020.
Welcome back to Your Wealth Health. I'm Erik Brenner, the owner of Hilltop Wealth Solutions, and I'm here in studio with private wealth advisor Bill Davis, and our director of wealth management, Matt Aurenz, joins us from his home office in Valparaiso. And today we're talking about investment strategy during these volatile times. You know, Bill, before we start, hopefully you ate enough turkey over the Thanksgiving holiday, and you know, it certainly was a different one.
Yes.
But we
I
can
know
hope
a lot of people had to change their plans, and that was unfortunate, but I think that was the prudent thing to do.
Yeah. Next year will be better.
That's
Look
right.
for next year. So let's take a look at a graphic, Bill, that shows how volatile the markets have been, you know, really over the period of time here. And this is a really interesting graphic to us.
Yeah, it's the VIX Volatility Index, Erik, and so it measures a lot of things about what the market's expecting in relation to volatility of returns. And so what you'll see here is, you know, is in June we kind of spiked out at above 40 on the VIX, but we settled down quite well into you know, late into early fall. But we've seen two recent spikes again in the VIX index, and what concerns me is how quickly the volatility moves. And you'll see that it moved almost 75% in the period of November. And so, that alone is really a crazy movement, and so I think it's fine for longer-term investors that are able to deal with the emotions of the volatility. But if somebody is checking in on their 401k on a real regular basis, they could see some pretty serious volatility, and so the VIX index is that index that we're looking at that's showing the amount of volatility that the market's expecting.
You know, in this day and age, Bill, when we have the technology that we do, you know, it's a good thing and it can be a curse because, as you said, people can check in 24 hours a day, 7 days a week, right, on their accounts.
On their smartphone or their computer or whatever, yeah.
Yeah, and it wasn't just long ago, a few years ago that, you know, you got your quarterly statement, and so oftentimes this volatility would kind of play itself out in the quarter. Mm-hmm. A lot of people even got, you know, semi-annual and annual statements. So, and then the other challenge is really going to, Matt, where do people go? You know, it's just not the day or the day is gone where somebody can just go into a real conservative investment, cash or even bonds, and be okay with the return that they're getting.
You're right, Erik. That's the challenge, is how do you take risk off the table in this type of environment with interest rates at all-time lows? And that's what I think we're seeing with a lot of people right now is they've rallied back in their portfolios, and now they're looking to capture some profit and put it into places that just prevent less volatility, less risk. And the fixed income bond market is the place that most people go with that money. And in the past, they've been rewarded. It's paid them nicely, but going forward, that's the concern that we believe is going to be pretty challenging. And if you take a look at our graphic here, it talks about lower bond rate returns. And just that is, it's basically saying, hey, we're at the lowest interest rate environment that we've ever seen. And the 10-year Treasury is at about 0.86%. So there's not really much room to get paid on anything. And when you think about inflation is outpacing that. So you're actually losing the value, the purchasing power of your money on an annual basis by leaving it in there long term. And even if you look at the last decade, you know, this rolling return says, hey, over that 10-year period, bonds returned 4%. In the early 2000s, it was 6.3. You know, but back in 1980s, you're paying 12.5%. And if you think about even just going back to 2007, Erik, you know, money markets were paying 5%. And good luck finding a money market paying that today with risk-free assets. So what we're saying is, in a rising interest rate environment, a flat interest rate environment, bonds aren't going to do well going forward. And we just feel like you have to find other places to put money to generate some type of return, because people have become accustomed to, you know, the fixed income world pay them 4, 5, 6%. And that's just not going to be the case going forward.
Yeah, so Bill, think about that. I mean, that graphic right there that we're showing, 5% average across all 10-year rolling periods since 1926. So averaging 5% over the 10-year rolling periods. And boy, that just doesn't seem like we're going to be there in the next 10 years.
Yeah,
at
that's
all.
going to be the challenge. And so what Matt's pointing out is kind of looking out into the future as to where the fixed income world's going. And so I expect that we will stay in these low interest rate environments for many years to come. So therefore, this diversified approach to dividend paying equities, still utilizing certain segments of the bond market that might generate higher yield, but also could bring more risk. So, this whole topic today is about managing your risks. And a lot of people don't think that they're taking on risk by increasing their bond portfolio. But when we do get to a rising interest rate environment, although we think it's quite a ways down the future, different types of bonds are going to go down in value when interest rates go up.
Yeah, and so we're really talking, for those of you out there today watching, we're really honing in especially on those that are going to be retired or retired. Because, a lot of people get into that point, which makes a lot of sense on, they get to retirement or in retirement and they want to be more conservative, and that's going to be the challenge. The other thing that we want to have people aware of, don't necessarily get put into or advised into something that maybe has some guarantees attached, annuities and so forth. We just don't want people making decisions that down the road that may not be the best decision.
Yeah, we're in situations now where we're trying to create people's retirement income strategies, and you oftentimes will find that they bought into a product 5 or 6 or 7 years ago that didn't pan out to be exactly what they thought it would be, and we're a little bit handcuffed with utilizing those investments that they made, those products that for their retirement income strategy. So we don't want to be handcuffed with coming up with the income strategy for retirement.
Yeah. So, Matt, to switch gears a little bit, a lot of folks, when it comes to the election, people get pretty concerned about what's going to happen to the markets and whether it's Democrat or Republican. And, history at least shows that, markets have gone up regardless of what political powers in the White House.
You're exactly right, Eric, and that's one comforting fact about change of powers and everybody being really concerned about what's going to happen every time somebody new gets elected. And you can see here on the screen, regardless of who's in power, what we see is the market continues to expand, the market continues to grow, and it's become lucrative for investors. And so our belief is that that trend will not change. To your point earlier, the destination, we know where it's going. The journey might look a little different, might look a little volatile, but we believe that we're going to continue to trend upward regardless of who is in office.
Yeah. So real quickly, Bill, we've got this next graphic, which is a pretty busy one.
Yeah,
it's
yes,
a lot
it is.
a lot going on.
A lot going
but
on.
we just wanted to point out that if you focus on the colors, right? So if someone focuses on the colors, those are asset classes, and they'll see really that it's kind of all over the board. In fact, they call this the quilt chart often, right? It's all over the board as to what finishes the top that year.
Yeah, you look at 2018, that's a real recent example where the market finished negative. And U.S. bonds were actually the leading asset class. Here we are talking about bonds going down in value, but in 2018 they were a saving grace. They didn't lose any principal value. And then U.S. large cap was down 4.5%, but came back the next year as the top at 31.5%. You can see commodities have trailed most of the 10-year periods, where real estate has been strong 4 of the 10 years. And so it leads us back to the diversification of a portfolio, to have money in each of these categories, because we don't know which one's going to be at the top of the quilt chart next year.
Yeah, great. Thanks, Bill. So once again, if you have questions about your investment portfolio, we want to help. We're offering a complimentary investment analysis. It's a value of about $800 to $1,500, but we will underwrite those costs. And to take advantage of this offer, call the number on your screen. That number is 574-633-1476. Again, that's 574-633-1476. We have people standing by right now to take your call. You can also sign up for this offer on our website at hilltopwealthsolutions.com. Still to come on Your Wealth Health, we're going to show you how we've helped some people just like you with their portfolio decisions. And once again, here's that phone number you can call to get your complimentary investment analysis.
I cannot work, do e-learning, and keep this house clean.
We should try Kay's way. We heard you were dirty, so we came in a hurry. We can't help you with the e-learning, but we can help you with the cleaning. Try Kay's way.
Welcome back to Your Wealth Health. I'm Erik Brenner along with Bill Davis and Matt Aurenz, and we're talking about investment strategies. And we want to show you a case involving a typical couple here. And so, Bill, what we do is, it's not just about where we feel or, how we think about a portfolio. We really want to analyze it and use tools, sophisticated tools to analyze one situation as it relates to risk.
Yeah, so we're not guessing, right?
Yeah.
We're not, as we were showing in the first part of the show, is that you can't guess what's going to do the best next year or in the years to come. And then looking backwards doesn't help you to plan going forward on your investment mix. So we utilize sophisticated tools. In this case, and for today's example, we're going to use Riskalyze. And we just used the average 401k balance out there in the United States is about $115,000 for people between 49 and 56. So we didn't do anything. We didn't make anything up here that's not realistic. And so we can jump into portfolio number one.
Yeah, so let's take a look at that. So the way that this works is that on the screen you'll see kind of a speed limit number. And, in this case, it's 53. And so 1 is no risk, 99 is the highest risk. And so, Matt, let's just kind of walk through, it's got that, what we call a probability of success, showing kind of a low and a high. And, the software really analyzes, what's the probability of one's portfolio over the next 6 months falling within that goalpost.
Thanks, Eric. So that's exactly right. You get a probability of a goalpost, basically a lower and an upper that says, hey, within the next 6 months, there's a 95% probability that your returns are going to fall within this range. And when we take a look at this first portfolio, it's again, to Bill's point, it's just a typical one that we see in 401k plans today. Has a risk number of 53, so kind of middle of the road. And it has a return range between negative 10.5% and positive almost 19%. And the portfolio is saying, hey, based on forward looking, we expect that this portfolio should return an annualized rate of around 8.3%. The dividend coming off of that is around 1.05, and the expense ratio is about 1%. So it's costing you as an investor around 1% to invest in this portfolio. But as an investor, you can sit back and say, okay, I know what my expected rate of return range is going to be. Am I comfortable with this? Am I comfortable with, if I see my portfolio drop by 9.5%, can I sleep at night? Is that expected? And it allows you to make downside protection risks in your portfolio to make sure that you know where it's going. You can sleep at night. You have an idea of where my destination is, but I know that journey is going to be kind of all over the place until we get there. So that's really what the current portfolio, or in this scenario, portfolio one looks like.
So, Bill, we have had times, including this year, where portfolios jumped out of that probability of success range.
Yeah, we've seen it 2 times in 12 years. We saw it in 2008 when we had the financial crisis. We busted the bank, so to speak. You see 95% probability, and you have to expect that, a couple times every century you're going to break the bank, and we did it again in March of this year. So if you were expecting to go down -10, you could have gone down as much as -20. So we're not looking forward to any of those events coming soon, but we don't know.
Yeah. The other important factor here is that, one situation often they have multiple accounts. So, if they're married, maybe each of them has a retirement plan, IRAs, other accounts. And oftentimes they don't do a good job of looking at all of them combined.
That's correct. So this tool allows us to go account by account. So many times I have a client that wants to go a speed limit of 35, and the other client wants to go a speed limit of 65. And we can accommodate that within the software. But then it'll give us a combined, that's 35, 65, it'll give us a total number as far as what's the downside risk and what's the expected rate of return.
Yeah. So if we look at the other portfolio, Matt, then really what it shows here is an increased risk number, but maybe not quite getting the return out of the portfolio.
You're right, Eric. So in this one, portfolio 2, we see oftentimes has a little bit more risk. And what people will say is, well, if I'm taking more risk, my return should be higher. And while that makes sense, that's not always the case. And in this portfolio, we see that. We see a risk number of 68 as compared to 53. But when you take a look at the potential return, we're seeing it's only 7%, where the other portfolio is 8.3. So we've increased our risk by a little over 30%, but we've reduced our return. Now, the other thing to note is, just because, we hear it often, is low-cost investing is the only way to go. And while we believe that that's true, oftentimes what we do see here in this one is the expense ratio is now only 5 basis points, 0.05, but that doesn't really help the portfolio. So sometimes it's worth paying a little bit more to generate better returns. But the overall thing here is we actually see the portfolio has a higher risk factor, but it's generating less return. And I think for most people, that's not a place that they want to be. That's not a place they would feel comfortable with. I don't want to take more risk and generate less return. So again, it's one of those things where you have to know where you lie. And as long as you're comfortable with it, that's okay. But if we can tweak that portfolio to say, hey, we can actually take less risk in your account and generate better returns, I think most people would agree that's a win-win for everybody.
So, Bill, this is really what we're offering up today is, diving into someone's portfolio like they see here that we've shown.
Correct.
And really determining what is your risk, and then talking about, do you want to make some changes?
Yeah, because we can either look at changing the investment mix or the percentage of what's allocated to each one, and that's current value and future contributions.
Yeah, great. Thanks, Bill. So at Hilltop, we are committed to educating the public and giving back to our community, and that's really why we're offering up this complimentary investment analysis. It is a value of between $800 to $1,500, and we're going to underwrite those costs. So to take advantage of this, it's important that you call the number on your screen, and that number is 574-633-1476. We have people standing by right now to take your call. You can also sign up for this offer on our website at hilltopwealthsolutions.com. Well, that's all the time we have for today's show. For Bill Davis, Matt Aurenz, and the entire Hilltop team, I'm Erik Brenner. Thank you so much for watching this morning. We'll see you next week. Until then, stay wealthy, Michiana.